Hey, welcome everybody to the 40 Finance channel. My name is Jeff Beers. Here we are in July, so it's time to start thinking about the back half of 2022 for the stock market. Obviously, the first half was complete misery and ranks up there with the worst starts all time for the S&P 500. And even though things have not been good for most of us in the first part of the year, there is the now factor. What if you started today? What if you were at par today and you bought one share of QQQ or one share of S&P 500? Where do you think that share would go towards the back half of the year? So this is not about returning to all-time highs. This is not about recouping all of your losses. This is about thinking what will win through July through December as we head into 2023. And the thing that got me thinking about this was this tweet from a person I follow. I do not know Stephen Wealthy, but I follow him on Twitter. He's a QQQ investor. Very proudly talks about it quite a bit, so I follow him on Twitter. And he came out and did this recap of S&P end-of-year predictions as they come from today. So a lot of the major analysts, major investing firms do a mid-year projection, right? And oftentimes when tracking your investments, you think about the full year performance, right? So January through December. But then there's the back half, if you were to just hold or perhaps add more, DCA down, what could happen then and how would that make your full year returns look? And what Stephen put together here, the top 15 investment banks shared their predictions last week, okay? So you see this was a tweet on July 5th. So let's take a look here. This is just a recap graph of S&P 500 year to date. I think we all know where that is. We were at 4,800. We're currently right in the 3,800 line. So where do the pros or the investment banks think we will go? Well, Bank of America, according to Stephen, I'm just going to take his word that he wrote all this down and took good notes. He has Bank of America 4,500 in their mid-year projection. That is plus 17% from today. Credit Suisse 4,900 plus 28%. CFRA plus 22. BMO plus 25, Citigroup plus 10%, JP Morgan plus 28, Evercore plus 25, Deutsche Bank 24, Goldman Sachs plus 12, Morgan Stanley only plus 2, so they're the low bar so far on this list. Oppenheimer plus 40%, Wells Fargo plus 12, Barclays plus 17, UBS plus 27, and RBC coming in right about plus 23%. Then he goes on to give us the recap. The average, according to his calculations, was S&P hitting 4,600, assuming that all these predictions come to pass. So 4,600, that's plus 20% from the 3,800 level today. No one had the S&P going down. You had 14 banks calling for higher, and you had one flat, and I'm guessing by flat it's this Morgan Stanley at plus 2%. Now for me, I wanted to dig in a little deeper from that tweet, so I went seeking alpha and started looking up like S&P projections, and I found a few articles that add more color in the sense of why analysts are predicting, plus 20% to the back half of the year. Is it just because we've been beaten down so far, or do they actually see legitimate growth opportunities in certain sectors? Remember, the S&P 500 covers a lot of stuff, including oil and gas and consumer staples, right? So as compared to the QQQ, which has some of those things, but not oil and gas and is very tech-orientated, this can give us some insight on, which one might be the better purchase. By the way, this platform I'm using today, Seeking Alpha Premium, something that I feature on my channel all the time if you haven't been here before. And there's a significant discount and a free trial just for you. You can potentially support the channel and get some outstanding stock information and data right at your fingertips. So check that out. But let's see how Oppenheimer breaks this out. And they did, just to be fair to Oppenheimer, it looks like they pulled back their estimate a little bit because it says they no longer expect it to finish above 5,000, but they're still counting on a big second half rally, and they changed to 4,800 is their target level from 5,330. So let's see what prompted that cut. Oppenheimer's new target is based on our earnings projection of $230 per share for the S&P 500, which is unchanged from previous forecast, and which, coupled with our revised target, implies a PE multiple of 20.9x. Go on to comment that they continue to favor cyclicals over defensive stocks, and from an allocation standpoint, they're in at 25% tech, 13.7% in healthcare, consumer discretionary 12.5%, financials 12%, industrials 10%, communication services 9%, staples 5%, energy only 5%, materials 3.2%, real estate 2.7%, and utilities 2.5%. So what's interesting, I guess, to me right there is as the oil stocks have been so popular and have performed so very well in the first part of the year, they're actually backing off of some of that allocation. Materials too, when you think about inflation, you've got a combination between energy, staples, and materials. That's coming in about 13% of their recommended allocation, whereas technology, which is beaten down the most, is at 25% recommended allocation. All right, next article I found, this one about Credit Suisse. They also cut their S&P price target. Let's see what's going on here. Given the current earnings trends and elevated nominal GDP, we reiterate our 2022 to 2023 EPS estimates of $2.35 and $2.55, implying 12% and 8.5% growth. Our target is being adjusted lower to reflect the higher cost of capital and valuations, not recessionary concerns. Our projected upside through year end assumes 1 to 2x multiple points of re-rating from currently depressed levels as macro uncertainty fades. Macro uncertainty, obviously you're talking about oil prices, inflation, potentially Russia-Ukraine coming to a resolution, all the things that continue to push the market down, at least as we head into July. Okay, and one more here. This one a little bit older, June 27th. Citi cuts S&P target to 4,200. Let's see what they say. Essentially, equity investors need to allow for a toggle between interest rate and earnings influences. Our view is that the rising rate-triggered valuation reset, which started in January, is mostly priced in. This is reflected in our move away from value style preference to a more style agnostic approach. The premise of this was work showing that the bulk of the rising rate effect has been on growth valuations more so than value. Scrolling down, in turn, if year-to-date valuation compression has largely discounted rate effects, then expected earnings growth now becomes the more relevant incremental stock price driver. Citi's overall S&P target is weighted between three scenarios. A soft landing where growth remains near trend, inflation moderates, and rate hikes are sufficient to tame prices. That gets a 55% weighting and would take the S&P to 4,700. Higher inflation is another scenario, and that's given a 40% weighting and would take the S&P to 3,650, which is actually lower than we're at today. A global recession where rate hikes persist in a whatever it takes tightening, even as growth slows, that gets a 5% weighting and would push the S&P down to 3,150, which is obviously significantly lower than we're at today. Off the top of my head, that's about 20% lower. But again, that's a 5% chance. They say there's a 40% chance S&P, under certain situations, could drop below where it is today. So put those two together and you got 45%. But their overall expected outcome, I guess you would say, that gets a 55% weighting, actually takes the S&P to 4,700. Now, I don't know why at 55% this is 4,700, but you see the headline here cuts to 4,200. Maybe that's because they took this number, this was their original target, and they brought it down a little bit. I think that's represented right here. Citi cut its target for S&P to 42 from 47. That's still about 8% higher than current levels as the firm expects earnings to be resilient. All right, so what if you want to bank on those projections and think about, what's an easy way to make money? Assuming the S&P 500 goes up from here, well, then it's pretty easy because the S&P is very accessible throughout multiple ETFs. Probably the most liquid and best known one is SPY, but there's also a Vanguard version that will do just as well and I think has lower fees. But you'd be coming in at 388 today, and I believe that original tweet we were looking at had an average of about 20%. So if that were to hit by December 31st, 20% of, let's call it 390, so adding $78 would put you somewhere in the neighborhood of 450, I believe, and that is down year to date, but near the price we saw back in January. Now, if you're feeling really good about the S&P 500 and you want to triple down on it, there's also the UPRO, which is a leveraged ETF, and I'll go down here to the description. It seeks to track 3x the daily performance of the S&P 500. So UPRO from this level could potentially give you 3x whatever the S&P jumps up to, but it could also give you 3x of any decline. So, on a 10% level, if you were in the SPY, you'd get your 10% from this point, assuming that it went up. So you'd get a 10%, but if you had the same dollar level investment in UPRO, you could get up to 30%. Now, it won't stack up exactly to 30% in that scenario because it's based on the daily average. There's also some fees involved. But it is an idea, and I talk a lot about the TQQQ, which I hold a small percentage of while I'm building a bigger position in QQQ. So one idea for the right investor with the right risk threshold could be to build up your shares of SPY. Then you could have a small slice of the UPRO because it's much more risky, and potentially 3x some of your bet on the S&P 500. Just know that these are all projections and things could easily go down, even though the outlook right now seems very positive. All right, guys, so the second half outlook for S&P 500, at least across 15 of the biggest banks on the planet, is generally positive, right? We had one flat, we had a couple that have cut back on their projections, but there's a lot of people saying back half of the year looks much better than the first half of the year for the S&P 500. The key to understanding this, though, is if you purchase today, right? So if you buy essentially on the end of June, first part of July, when we're at this 3,800 level, that's where the gain is. It's not the same thing as buying at 3,800 and expecting it to get back to 47 or 48, wherever it stood way back in January. It's about making money from what you purchased today. And of course, there's tons of variables out in the world right now. So always do your own research and don't just go off somebody else's projections. All right, before you go, don't forget to check out that special offer for Seeking Alpha Premium in the description below. Hope everybody's doing well, and we'll see you on the next video.